in terms of the local monetary policy, we do expect the Malaysian Central Bank to cut interest rate one time in the first half of this year. And in terms of the impact on the market, especially the fixed income market, we think it won't be much because it is quite well flagged. Many people are already aware of it. So it wouldn't be a surprise if it happens. And typically, the sector that's affected directly in terms of their profitability will be the banking sector. Because when central bank cut interest rate, what you see is that their lending rate will also decline. But the good news is that many commercial banks in Malaysia are quite prepared for this, and what they've been doing is they've been holding back on fixed deposit rate, meaning they've been controlling themselves from giving very high fixed deposit rate, which is why if you go to the market recently, you struggle to find very attractive fixed deposit rate. So the funding cost of the banks has come down because of the lower fixed deposit rate. So they are prepared for the lower lending rate when interest rate cut happens. Two catalysts for Asian equities. The first is that what we've been observing is when we look at global economic data, it's been stabilizing, and here and there we are already seeing some form of improvement. Just to give you an example, if you look at China purchasing manager index, it has gone up in the past 3 months. So that's a form of indicator that things are stabilizing or improving. Now the second thing is that when you see the global manufacturing segment improve, typically you tend to see the emerging market, including Asian market, to benefit more than the US. The reason is because US is more service oriented. There's less manufacturing base in US, whereas there's a lot of manufacturing base in Asia. So typically if you see global manufacturing environment start to improve, you should see the Asian economy benefit more. And in such environment, you tend to see some kind of fund outflow from the US into emerging market, including Asia. So that is good for the Asian currency. Now, when Asian currency strengthen against US dollar, that is also typically good for the Asian equity market. So you have one, improving global economy, especially in the manufacturing segment, and two, you have stronger Asian currency versus US dollar. Now these two factors tend to be good for the Asian stock market. In terms of longer term multi-year holding, for a long time we like sectors with sustainable growth, and we like companies with strong business modes. We find such companies typically in the internet segment and some of the Chinese insurance company. We have names like Tencent, we have names like Alibaba. In terms of China insurance, we like names like Ping An Insurance and AIA. Both these sectors are benefiting from low penetration rate, so there's a lot of room for growth, and these companies also have very strong execution track record and strong business mode. It's hard for competitors to compete against them. Now that's for a multi-year angle. In terms of a mid-cycle angle, for example, in the next 12 months, we do like the semiconductor space in Korea and Taiwan. We have names like Samsung Electronics and Taiwan Semiconductor.